I'm Reed, I'm Arshid, just an average dude. I've made tons of money mistakes in my Arshamouse, and now I want to share everything I've learned to help you take control of your finances and your life. Alright. So today we need to talk about something pretty massive, something that is making waves on Wall Street, and honestly should be making you pay attention. JP Morgan, one of the biggest banks in the world, just officially took Goldilocks off the table. Now, this isn't some minor tweak to a spreadsheet or a tiny adjustment in some obscure financial report. This is a fundamental shift in their outlook, and it's a big, flashing warning sign. They're no longer comfortable with the idea of an economy that is just right, and they're now far more concerned about a negative growth shock. And here is the kicker. This isn't coming out of nowhere. It is the next stage of a problem that has been brewing and showing very clear signs throughout Yanseni Arshase. And frankly, a lot of people, including myself at times, missed it because we were listening to the wrong narratives. When I was in my early 20s, I was constantly looking for the easy way out, the quick fix to my financial problems. I wanted to believe in Goldilocks scenarios for my own money, where everything would just magically work out without me having to put in the hard work or face the uncomfortable truths. I was spending more than I earned, building up debt, and ignoring all the warning signs. I was buying into the idea that things would always improve, that the market would always go up, that I'd somehow stumble into wealth. It took hitting rock bottom with a pile of debt and no savings to realize that ignoring reality doesn't make it go away, it just makes it worse. So when a big institution like JP Morgan finally admits that the just right scenario is gone, it is a wake-up call. We all need to heed. It means we have to stop pretending everything is fine and start looking at the real issues. Let's break this down into 3 parts because it is crucial to understand what this really means. First, we'll dive into what JP Morgan's declaration means, this whole Goldilocks leaving the building thing, and why a negative growth shock is such a big deal. Second, we'll explore why the economy is in such a vulnerable position, how consumers and businesses were already struggling long before this Wall Street downgrade. And third, and this is perhaps the most important, we'll talk about why the Yanseni Arshase rule warning was so critical, why it was dismissed by so many, and why the labor market has been the real story this entire time, even when the headlines tried to tell us otherwise. The problem has always been that too many people kept mistaking the stock market, the official unemployment rate, and a few headline payroll numbers for the actual health of the economy. But those things, they're often lagging indicators, or they paint a very narrow picture. And now, Goldilocks isn't just gone, she has packed her bags, sold her house, and there is no way for her to come back, at least not anytime soon. So what does it mean when JP Morgan says Goldilocks has left the building? According to their report, they're no longer comfortable with the Goldilocks setup. What was that setup? It was simple: growth slows, but not too much. Inflation cools, but not because demand collapses. The labor market softens, but it doesn't break. Corporate profits hold up, so does the stock market. The Fed eventually cuts rates. Stocks keep levitating. Everyone gets to pretend the business cycle has been repealed. That was Goldilocks. Not too hot, not too cold, just perfect, and right to continue buying risky assets. It was this idea that we could have a perfectly smooth transition, a soft landing, where all the good things kept happening and all the bad things were kept at bay. It was the best of all possible worlds, a fantasy almost. And it led many, including myself when I was younger, to believe that I could take excessive risks with my money without consequence. I thought if the big banks and the news were saying everything was perfect, then surely my reckless spending and investing would be fine too. But that is not how reality works, and it's certainly not how the economy works. But now, JP Morgan is talking about the risk of a negative growth shock. And that, my friends, is the entire ballgame. A negative growth shock is not growth that slows from great to good. It is not that consumers rotate from goods to services, like we kept hearing for months. It is not temporary uncertainty. It means the downside is moving from theoretical to visible. It means the economy may not be gently cooling. It may already be rolling over, or worse, already in a downturn that hasn't been officially recognized. This is where the timing gets important. JP Morgan is not discovering an economy that was healthy yesterday and weak today. Wall Street is merely catching up to a deterioration that has been building all this time slowly, silently, but relentlessly. It is the same pattern we've seen again and again throughout history. First, the data starts to wobble, subtle shifts that are easy to dismiss. Then consumers start telling surveys that something big is wrong, their sentiment turning negative, despite official reassurances. Then companies start talking about challenging conditions or affordability pressures. Then hiring slows down, job openings disappear, quit rates fall, the unemployment rate starts to move, and then everyone, at least initially, tries to explain it away. They come up with all sorts of benign explanations, trying to fit the square peg of reality into the round hole of their preferred narrative, and only after the evidence piles up high enough that even Wall Street can't step over it anymore, does the official narrative finally change. That is what Goldilocks is leaving the building really means. It means the narrative is being revised, not because the economy just changed, but because the economy had already shifted long before, and the people at the top are finally being forced to admit it. It is a delayed acknowledgement of a reality that has been unfolding right in front of us, if only we were paying attention to the right signals. And the reason why JP Morgan's shift matters so much is because it finally admits what many of us have been saying all this time. The economy is fragile, not strong and resilient. Yes, we had an energy shock. But the energy shock in its historical context is not just about the price of oil or gas. It is the dangerous marriage between that shock and a fragile economy that simply cannot afford to pay for it. Consumers weren't sitting there with massive excess savings and secure jobs, just waiting to absorb higher prices and energy costs and an even weaker labor market. Oh no, they were already stretched thin. We've heard it from fast food companies and retailers. We've heard it from appliance makers, packaged food companies, management teams across various industries. They keep reaching for polite language, things like challenging consumer environment and affordability pressures or value-seeking behavior. Because let's be honest, CEOs generally don't go on earnings calls and flat out say, "Our customers are broke." But that is increasingly what the polite language actually means. It means people are struggling to make ends meet. It means they're cutting back on discretionary spending, trading down to cheaper alternatives, and feeling the pinch in their wallets. And that is why the Goldilocks story was always so fragile, always based on a shaky foundation. It depended on the idea that consumers could keep spending despite a labor market that was already cooling and despite incomes that were not keeping up with the real cost of living for most, the vast majority of households. That is not Goldilocks. That is a pressure cooker. The stock market may have been pricing perfection, living in its own little bubble, but the household economy, the real economy where people live and work, was pricing survival, and there is a massive difference between those two things. When I was in debt, I saw how quickly small increases in prices or interest rates could push me further into the red. I didn't have a cushion. Many households today don't have that cushion either. So, when external shocks hit, they don't just absorb them, they buckle under the pressure. And that has been the real story the entire time. The survival, the lack of income growth for many, the increasing lack of job opportunities for others. Not just the first Friday of every month and what the payroll report might say, at least today before it gets revised down the line. The real story has always been in the jobs market, the actual, gritty reality of employment for the average person. And when you look at it broadly, the picture has been deteriorating since 1990. Job openings declined, quits declined, hiring disappeared, full-time employment came under pressure. The household survey, which often tells a more accurate story about actual employment than the establishment survey, showed very serious weakness. Labor force participation, a very important metric, stopped improving. Continuing jobless claims were elevated, meaning more people were staying on unemployment benefits longer. Challenger layoff announcements kept reminding everyone that companies were no longer in expansion mode, they were actively trying to shed costs. And even when the establishment survey printed a positive number, the internals were often nowhere near as strong as the headline suggested. It is not always about mass layoffs that make the news. Sometimes it starts with no hiring at all, then fewer hours for existing employees, then fewer people quitting their jobs because there are no better alternatives, fewer opportunities overall. Then, people who lose jobs take longer to find new ones. Then new entrants to the workforce, like young graduates, can't get a foothold, youth unemployment skyrockets, then discouraged workers stop looking for work altogether. And when people stop looking for work, the unemployment rate doesn't rise as much as it should, because they are disappearing from the official labor force count. That is the kind of labor market where the official unemployment rate can look perfectly stable, perfectly Goldilocks, while the actual unemployment situation gets to be worse and worse and worse for millions of people. This is the very essence of what flat beverages means in practical terms. A labor market that is stagnating or slowly declining, not thriving. And that is exactly the environment in which a negative growth shock becomes truly dangerous. Because if the labor market was already fragile before the shock, then the shock doesn't create the problem. It exposes it brutally and unforgivingly. Now, let's get to a key piece of evidence here, the SAM rule, which, by the way, is not really the SAM rule. Claudia Sam, who popularized it, took it from other people who had previously looked into the labor market, and it is really about momentum in unemployment, how that is captured in changes in the unemployment rate itself. The rule is very simple, and I've talked about it before. When the unemployment rate on a 3-month average basis compared to its low from the previous 12 months rises by half a percentage point or more, historically, that has been a recession signal. It is not magic. It is not complicated. It is basically, as I said, a momentum gauge for the overall labor market. When unemployment starts rising quickly enough, it usually doesn't stop on its own. The labor market shifts, the business cycle turns. What looks like a mild increase becomes something much larger because weakness feeds on itself in a vicious cycle. And in Arsi, the SAM rule did indeed trigger. It jumped past Wu and had everyone talking about it. And importantly, the Japanese started trading out, specifically the Japanese carry traders, and both of those taken together, especially, should have been treated as a major warning. But what happened instead, the Fed said the labor market is just normalizing. Economists said, the rise in unemployment was not recessionary. The mainstream media said immigration and labor supply were distorting the numbers. Others said it was just natural cooling that everyone wanted after the so-called red-hot labor market of Ardeen Aryal and Ardeen RR. Even Claudia Sam herself, who the rule is named after, spent time downplaying the signal that was attached to her own name. It was almost like everyone wanted to ignore the clear warning signs. I remember trying to rationalize my own bad financial decisions, telling myself, it is just a temporary setback, or things will get better on their own. That is exactly what was happening with the SAM rule. But the rule was not supposed to be a vibe check. It was supposed to tell you when the labor market and its momentum had shifted too far in the wrong direction. And that is exactly what happened. The problem was that everyone expected the confirmation to come from the same place.